The person who retired at 58 last year probably did it with a smaller portfolio than you think. And they did it by owning 3 specific assets in a specific order. By the end of this video, you'll know exactly which assets, exactly how much capital each one requires to replace real income, and a tax mechanism sitting inside the third asset that can shrink your actual retirement income requirement by 15 to 20%. Most videos about this topic never calculate that last part with real numbers. I'm going to. Before we get anywhere near the assets themselves, here's the brutal reality. The Federal Reserve's survey of consumer finances puts the median retirement savings for Americans aged 55 to 64 at $185,000. Not $185,000 per year in income. $185,000 total. That same person, if they've been working since their early 20s, has earned somewhere between $1.5 and $2.5 million over their career. $185,000 kept from $2 million generated, about 9 cents on the dollar. The conventional response to that statistic is, you should have saved more. That answer misses the actual problem. The problem isn't the savings rate. The problem is the mental model. 30 years of being told to fill a bucket, save, invest, grow the number, die with money in the bucket, when what you actually need is a pipe. A bucket is a finite pool you draw from and hope runs out after you do. A pipe is an income stream that flows whether you're working or not a shrinking number, a flow. Every month, income arrives just like it did when you were employed. The bucket doesn't change. If you build the pipes right, the bucket keeps growing even while you're spending from it. That is financial independence. And it's a completely different experience than watching a balance sheet shrink. Pipes, not buckets. That phrase is coming back repeatedly. Now, before I get into the first asset, I want to set up something I'm going to show you in about 10 minutes that changes the retirement math for almost everyone watching. It involves a specific IRS-designated tax bracket that most people who are building toward retirement have never calculated for their own situation. I'll give you exact income thresholds and what they mean in real dollars. Stay with me. But first, here's how broken the standard playbook actually is. The 4% rule. Developed in 1994 by financial planner William Bengen, who ran portfolio simulations against historical market data and concluded that a retiree could withdraw 4% of their portfolio in year 1, adjust for inflation annually, and have a high probability of not running out of money over a 30-year retirement. That became the bedrock of American retirement planning. And for 30 years, it worked as a reasonable rule of thumb. Here is what happened to it. Morningstar published updated research at the end of 2025. For a 30-year retirement horizon with a 90% success probability, their current estimate for a safe starting withdrawal rate is 3.9%, still close to 4. But for a 40-year retirement, which is what you're looking at if you retire at 55 or 58, their research lands at 3.1%. Under current equity valuations and portfolio construction assumptions, the number drops that far. That doesn't sound like a dramatic difference. The math is unforgiving. At 4%, you need 25 times your annual spending to retire safely. At 3.1%, you need over 32 times. On a $50,000 annual spending budget, that gap is the difference between needing $1,250,000 and needing $1,600,000. A $350,000 difference from a single decimal point. That's not a rounding error. That's a house. You think the problem is that you haven't saved enough. But actually the problem is that you're optimizing for a bucket that requires 32 times your annual spending to be statistically safe. When what you actually need is a pipe system that replaces your annual spending indefinitely without touching the principal at all. Different goal, different assets. Completely different math. Pipes, not buckets. Let's build the first one. There's a real estate attorney in the Midwest whose firm has 2 practice areas. One is real estate transactions, the other is bankruptcy. He has observed over a 20-year career that the same clients sometimes appear in both sides of his practice, separated by about a decade. Not because real estate is inherently dangerous, because the specific way most people approach it is They confuse an asset class with a strategy. Real estate is just land and buildings. What you do with the financing, the reserves, the property selection, the management, that's where durable income gets built, or where financial ruin quietly assembles itself. Here's a story I want to tell. Marcus is a warehouse supervisor in Indianapolis, $61,000 a year. Not wealthy, not struggling. In 2012, Marcus bought his first duplex for $138,000. He put $34,000 down, money he had deliberately saved over 4 years without touching a cent of it. After mortgage, insurance, property taxes, and a maintenance reserve of approximately 1% of property value annually, Marcus cleared about $560 per month in net cash flow. His coworkers thought he was ridiculous. $560 a month from a $138,000 investment sounded like a lot of capital for very little return. Marcus kept going. Second property in 2015, third in 2018, fourth in 2021. Each time, conservative financing, never above 70% loan to value. Properties in neighborhoods he actually drove through on weekends. Professional property management taking 8% of gross rent to handle everything from leaky faucets to lease renewals. Boring, methodical, relentlessly consistent. By 2024, Marcus's 4 properties generated just under $4,000 per month in net cash flow, $46,000 per year. That's 75% of his $61,000 salary, coming from 4 houses he doesn't have to show up to. Marcus stopped working at 60. Not because he hit some magic net worth number, because he had a pipe. Here is what Marcus did that most people attempting this don't. He never bought for appreciation, never stretched financing to make the spreadsheet look better, never chased a market he'd read about on a forum. Every property cash flowed on day one at real-world expenses, not optimistic projections. And he kept enough liquid reserves that when a water heater failed, when a tenant left in rough shape, when an HVAC unit gave out in July, none of it became a financial crisis. It was a maintenance expense, covered by the reserve, absorbed without drama. The people who build great rental portfolios and the people who file bankruptcy over real estate can look identical in year 2. Both have leveraged properties. Both have tenants. The difference shows up in year 8 when something breaks and one person has reserves and one person doesn't. That's the engineering behind a durable real estate income pipe. What does this pipe actually cost to build? If you need $45,000 to $50,000 a year in net rental income, and your average cash-on-cash return across properties is 8 to 10% after all real expenses, taxes, insurance, management, maintenance reserves, vacancy, you need roughly $500,000 to $600,000 in equity deployed. Not total property value, equity. 2 or 3 well-selected properties, conservatively financed, held in markets where housing demand is genuine and durable and not dependent on a single employer or tech boom. Here is the pattern that separates durable rental income from eventual disaster. Every tenant is 1 job loss from a late payment. Every roof is 10 years from a replacement. Every HVAC unit has a lifespan. Price both realities into your underwriting before you make an offer. That unglamorous math is what separates a real pipe from a ticking clock. So the real secret to real estate investing is just not being reckless with real estate. Yeah, basically, the bar is that low. You'd be surprised how many people trip over it. Pipe 1 is rental real estate, the most hands-on of the 3, potentially the highest cash yield. Requires conservative financing, genuine local market knowledge, and real reserves to survive the inevitable rough patches. It is not passive. It can be extremely profitable. Those 2 facts coexist comfortably. Now I want to set something up before we get to the second pipe, because this is where the psychology of retirement income starts to matter as much as the math. In a few minutes, I'm going to introduce you to someone who did everything right, saved everything she was supposed to save, invested consistently for 35 years, and is still quietly anxious every single day in retirement. Not because the numbers are bad, because she built a magnificent bucket and her brain knows it. The second pipe is what would have actually solved her problem. Pipe 2, dividend stocks. There is a concept called sequence of returns risk. Your financial advisor has probably mentioned it once. You nodded, you moved on. It is one of the most consequential ideas in all of retirement planning, and most people have never had it explained in a way that actually lands. Two retirees, same age, same starting portfolio size, $1 million. Same average annual investment return over 20 years. Same withdrawal amount. One runs out of money at 74. The other dies with more than they started with. The only difference is the order in which the good years and bad years arrived. Charles Schwab published a scenario that illustrates this. Investor 1 faces 15% losses in the first 2 years of retirement, while simultaneously withdrawing $50,000 per year to cover living expenses. Those withdrawals force him to sell shares at the bottom, shares he will never get back for the recovery. By year 18, his portfolio is gone. Investor 2 faces the same 15% drop, but in years 10 and 11, not years 1 and 2. By then, 12 years of compounding have already happened. His portfolio is large enough to absorb the crash and continue. Same average return, same withdrawal rate. One runs out of money, one doesn't. The only variable is when the crash arrived. That is sequence of returns risk, and is exactly why invest in index funds and withdraw 4% is an incomplete retirement plan without knowing what happens when the crash lands in year 3 of your retirement. Dividend stocks largely sidestep this problem. Here's why. When a high-quality dividend-paying company drops 30% in a market crash, they do not automatically cut the dividend. The S&P 500 Dividend Aristocrats. S&P Global's index of companies with at least 25 consecutive years of dividend increases achieved an annualized dividend growth rate of 8.1% over the 20 years through early 2025. That's more than 3 times the 2.6% CPI inflation rate over the same period, according to S&P Dow Jones Indices data. And during that same period, the dividend aristocrats maintained or raised their payouts through the 2008 financial crisis, the 2020 COVID crash, and the 2022 rate hike bear market. The stocks fell, the income didn't. Read that again slowly. The stocks fell, the income didn't. If your retirement income is coming from dividends, a market crash is an event you observe, not an event you survive. Your paper net worth declines. Your income deposit arrives on schedule anyway. You see the market down 30% on the news, and your actual life is completely unaffected because you are not selling shares. You are collecting distributions from businesses that are still operating, still profitable, still growing their payouts. That is a categorically different experience from watching a balance sheet shrink while wondering if it will outlast you. Pipes, not buckets. By the way, hit subscribe if you're finding this useful, because YouTube's algorithm may genuinely never show you one of my videos again if you don't. I know that sounds like an overstatement. Given how this platform works, it actually isn't. The honest math on this pipe: quality dividend payers, not the 8 and 10 and 12% yielders that look spectacular until the company cuts the payout and the stock drops. 50% typically yield between 2.5% and 4%. The dividend aristocrats have historically landed around 2.5 to 3% on average yield per data from S&P. Dow Jones and market analysts tracking the index in early 2026. Let's use 3% as a working number, because it's realistic and leaves room for lower yielding but faster growing names in the portfolio. To generate $40,000 a year in dividend income at 3%, you need $1,333,000. To generate $60,000 per year, $2 million. Those are large numbers. Two things make them more achievable than they initially sound. First, the compounding timeline. If you're 48 years old today and you invest $4,500 per month into a dividend growth portfolio, earning 7% total return, which is conservative by historical S&P standards, you cross $1,300,000 in approximately 12 years. You're 60 years old, which is pretty close to your target retirement window. Start earlier, and the math gets more forgiving fast. Second, the dividend aristocrats have historically raised their payouts at 8.1% per year over the last 20 years, according to S&P Dow Jones data published in May 2025. Inflation averaged around 2.5 to 3% over that same window. Your income pipe grows faster than inflation without you doing anything. Your $40,000 income in year 1 becomes $43,000 in year 2, $46,000 in year 3, automatically. The pipe expands on its own while you're living your life. That's the compounding story dividend investors keep talking about. It's not the stock price, it's the income stream that keeps growing. Now, the part most videos skip because it's uncomfortable, picking individual dividend stocks that will sustain and grow their payout for 15 to 20 years is genuinely difficult work. It requires reading balance sheets, understanding competitive moats, assessing management track records, monitoring debt levels across business cycles. It's more credit analysis than equity analysis. This is not a casual weekend research project with a stock screener. I have run meaningful capital through a dividend strategy for years. I've spent over a decade running my own business while surrounded by accountants and fiscal attorneys who taught me how money actually moves at the level where it matters. I have real skin in this game, not theory. And I still use a specialist for individual stock selection within this strategy. Someone doing this 50 hours a week for 15 years with a documented track record. If you don't have access to that kind of specialist dividend ETFs, do this job at very low cost. Vanguard Dividend Appreciation, Schwab US Dividend Equity, the ProShares S&P 500 Dividend Aristocrats ETF trading under the ticker NOBL. Diversified, cheap to own. They pay you on a predictable schedule. Your yield will be closer to 2 to 2.5%, which means you need a larger portfolio to hit the same income target, but the durability and the management costs essentially round down to zero. One more thing about those high yield dividend stocks showing 8, 10, 12%. They exist. They're real companies, and a meaningful percentage of them cut their dividend within 3 years of the yield climbing that high. The elevated yield is often the market's way of communicating that it doesn't believe the payment is sustainable. That is information worth having before you buy, not after your income drops 40% and the share price follows it down by another 30%. High yield in dividend investing is frequently a warning signal, not a reward. This is where I want to introduce someone I've been promising you since early in this video. Sandra is 63 years old. She has $900,000 in a 401k and a paid-off house in a mid-cost suburb. She did exactly what she was told. Saved diligently for 35 years, invested consistently, deferred lifestyle upgrades, made no catastrophic mistakes, did everything right. And now she's retired and quietly anxious every single day. Every month, Sandra withdraws $3,500 from her retirement account to cover living expenses. Every month, she watches the balance go down. In months when the market is also falling, the balance drops faster than her withdrawal. Her financial advisor has run the Monte Carlo projections. 92% probability of the money lasting her full retirement. Sandra doesn't feel like 92%. Sandra feels like she is holding a shrinking ice cube and the room is getting warmer. The financial services industry has known about this psychological phenomenon for decades. It's one of the structural reasons variable annuities have stayed alive as a product category long after their fee structures became widely understood. An annuity with a mortality and expense fee, a sub-account management fee, a rider fee, and an administrative charge that together total somewhere around 3 to 3.5% annually, but it produces a monthly income deposit. And that deposit feels like a paycheck, and the brain relaxes. So what's my total annual cost on this product? Roughly 3.5%, which means I need a 6.5% return before I've made a single dollar of real gain. Slow nod. They're selling a psychological fix to a brain problem you can solve for yourself for free with the right asset structure. With a dividend portfolio, you build yourself a self-constructed pension without the insurance company's markup and without surrender charges that lock your capital up for a decade. I'll come back to Sandra in a few minutes, because the third pipe is the complete solution to what she's actually experiencing, and it involves a tax mechanism that changes the capital requirement more dramatically than anything else in this video. But first, here's something I want to flag. Knowing these numbers and actually building a system around them are two very different things. I've had this data in front of me for years. The analysis, the tax math, the sequencing logic. And for a while, it sat in a spreadsheet. Understanding something and operationalizing it are different skills entirely. That gap is exactly why I built the Exit Code. It's a digital book, 8 chapters of actual retirement data analysis, no filler, built around a mathematical framework for determining when you can stop working, not based on some round number or age benchmark, but based on your specific income, spending, and asset trajectory. The research covers 50 years of retirement data. 2 things in particular are directly relevant to what we've been discussing. The first is what I call the dynamic withdrawal method, a replacement for the static 4% rule that accounts for the market environment you're actually retiring into, not the historical average. Given what Morningstar's most recent research shows about safe withdrawal rates for 40-year retirements, the static rule is increasingly inadequate as a planning tool. The second is a chapter on the insurance gap, what I call the $14,000 invisible bill. If you retire before 65, you lose access to Medicare, and the ACA marketplace becomes your only real option. In 2026, ACA premiums for a 62-year-old without a subsidy run between $12,000 and $21,000 per year in most states, per marketplace data. That is a line item almost nobody puts in their retirement projection until it's already destroying their plan. The Exit Code walks through the exact income management strategies that can qualify you for subsidy eligibility while still funding your actual lifestyle using the same account sequencing logic I'm going to explain in a few minutes. You can get it for less than a dinner out through the link in the description below. It's a book, not a course, not a coaching upsell. The math does the heavy lifting. Now, the third pipe, the diversified investment portfolio with a tax-optimized withdrawal sequence. This sounds like what everyone already does. Max your 401k, invest in index funds, withdraw in retirement, but there is a layer underneath that changes the math significantly, and it is almost never explained with actual numbers. Most people approaching retirement withdraw from their accounts in the worst possible tax sequence without knowing it. They pull from the taxable brokerage first, then the tax-deferred 401k and traditional IRA, and ignore the Roth until required minimum distributions force the issue. This feels intuitive. It is often suboptimal. Vanguard's own tools for tax-efficient withdrawal sequencing demonstrate that the order in which you pull from different account types can substantially change how long a portfolio lasts, not because the assets change, but because the tax drag on withdrawals changes. Now here is the specific mechanism I promised earlier in this video. Long-term capital gains, meaning gains on investments held more than 1 year, are taxed at 0% for single filers, with taxable income at or below $49,450 in 2026. Married filing jointly, the threshold is $98,900. According to IRS guidance and confirmed by the Tax Foundation, the CNBC, and Kiplinger, as of the 2026 tax year, 0 federal tax rate. On capital gains, if you structure your retirement income so that you're taking tax-free Roth distributions alongside long-term capital gains from a taxable brokerage account, and you time your Social Security start date to manage your income level, you can generate $50,000, $60,000, even $70,000 per year in retirement income and pay close to 0 in federal income tax. That is not a loophole. It is not an offshore structure. It is the standard United States tax code, sitting in plain view, available to any American who knows it exists and plans around it before they retire. What does that mean in practice? If you originally calculated that you needed $75,000 gross income per year to cover $60,000 in actual spending, assuming a 20% effective tax rate, and you now realize you can structure the income so that federal tax is near 0, you only need $60,000. Which means your required portfolio size shrinks by roughly 20% at any given withdrawal rate. On a 3.9% withdrawal rate, that gap in required capital is approximately $380,000. Not from earning more, not from a lucky market, from knowing one specific number inside the tax code and building your account structure around it before you retire. Here's the uncomfortable question that follows that number. Who benefits from you not knowing this? Financial advisors whose fees are calculated as a percentage of assets under management. The more assets you believe you need to retire safely, the longer you stay invested and the higher their annual fee. I'm not calling anyone a villain. The incentive structure just doesn't create a burning urgency to walk you through the 0% capital gains bracket proactively during your annual review. Amused disappointment, not rage. That's the right register for this. This is where it gets really interesting, because this isn't just a withdrawal strategy, it's a sequencing architecture. Which account you pull from in which year has permanent compounding consequences, and most people have never modeled it on a spreadsheet because they don't know the thresholds, and their advisor hasn't brought it up. Let me now build the complete picture. Here's the mini case study I've been setting up. David is 42 years old. He earns $95,000 a year as a project manager in the Southeast. He wants to retire at 58, 16 years from now. He's mapped his retirement expenses carefully, real line items, not a percentage of salary. His actual number is $60,000 per year after removing work-related costs. Add $8,000 for healthcare before Medicare eligibility at $65,000. Target income, $68,000 per year. David builds pipe 3 first, the diversified investment portfolio. Because it's liquid, it compounds immediately, and it provides the financial foundation that makes everything else safe to build on top of. He maxes his 401k at $24,500 per year, the 2026 IRS limit. His employer match adds $4,000. He contributes $7,500 to a Roth IRA annually, the 2026 IRA limit. He puts another $5,000 per year into a taxable brokerage account. Total invested annually, $41,000. At 7% average annual return over 16 years, David's combined portfolio at age 58 is approximately $1,240,000. The math holds at conservative assumptions. At age 47, 5 years into building the portfolio, with a meaningful liquidity cushion already established, David buys his first rental property, $220,000. A single-family home in a stable, mid-tier market with persistent housing demand. He puts $55,000 down. After all expenses, mortgage, property taxes, insurance, maintenance reserve, and a property manager taking 8% of gross rent, he nets approximately $570 per month. At 52, he buys a second property under similar terms. At 58, the two rental properties together generate about $15,000 per year in net cash flow. His portfolio needs to cover $53,000 per year. At 3.9% withdrawal from $1,240,000, he can draw $48,360. He's short $4,640. He has approximately $180,000 in his Roth account, completely tax-free. He takes $12,000 per year from the Roth. That puts him solidly in the black. Now, the tax structure. His income breaks down as $15,000 in rental income, which is offset partly by depreciation deductions, $48,000 in portfolio withdrawals, structured primarily as long-term capital gains from his taxable brokerage and Roth distributions that don't count as taxable income. His total taxable income stays below the 0% capital gains threshold for his filing status. His estimated federal income tax bill, approximately $1,900 on $68,000 of effective retirement income. David didn't earn an extraordinary salary. He didn't time the market. He didn't discover some alternative investment or obscure tax shelter. He built 3 pipes over 16 years in the correct order and managed the account structure. He is 58 years old and he does not need a job. That's the whole system. The order one more time, because this is the part that almost nobody explains and the reason I structured this video the way I did. Portfolio first, real estate second, dividend component inside the portfolio, built over the full timeline. The portfolio is liquid. It's your structural foundation and your emergency reserve. It means that when you add real estate, you're not leveraged to the edge of your financial life. You have cash for vacancies, repairs, bad tenants, bad months. Real estate without a liquid base is a ticking clock, not a pipe. The dividend component of the portfolio delivers its full power only when you've allowed the reinvestment compounding to run for a decade before switching to income mode. Interrupt the compounding cycle early and you permanently reduce the income stream the asset could have produced. Try to build real estate first without a portfolio base, and you're one bad event away from a forced sale at the worst possible time. Try to build dividend income first and tap it before the compounding runway is complete and you've cut the pipe before it reached full pressure. The sequence matters as much as the assets. Almost nobody tells you the sequence. Now stay with me, because what comes next resolves the Sandra story, and it's the actual psychological fix, not just the financial one. Sandra has $900,000 and she's anxious every day. Here is what a restructured approach looks like for her. $250,000 of her $900,000 moves into a dividend ETF structure, generating approximately 2.5% annually, about $520 per month in income deposits that arrive on a schedule, like a paycheck. A short bond ladder covering 2 years of expenses, structured to mature in predictable intervals, functions as a self-made certainty mechanism. The remaining balance continues to compound in a growth-oriented allocation. And she begins a Roth conversion strategy in her early retirement years, converting a portion of her traditional 401k to Roth each year at low tax rates, reducing future required minimum distributions, and building a tax-free reserve that won't trigger additional taxable income when she draws on it later. Her total portfolio doesn't grow faster. Her long-term math doesn't change dramatically. But now there are deposits arriving, not only withdrawals leaving, income flowing in, not only balance declining. Sandra's brain registers income instead of loss. The anxiety doesn't disappear, it becomes manageable. It stops being a daily presence and becomes an occasional check-in. The math was always fine. The structure finally matches how human brains actually process money. Pipes, not buckets. For Sandra, for David, for anyone building toward this. The difference between retiring at 58 and working until 66 is almost never the portfolio size. It's almost always the model, whether you're building toward a finite pool or toward a system of flows. 3 specific takeaways, not generic advice, calibrated to exactly what we discussed. 1, define your retirement target as an income number, not a net worth number. Sit down and map your actual retirement spending in line items, not a percentage of your current salary, not a round number someone handed you, not what a calculator defaulted to, real categories. Housing, food, transportation, travel, healthcare. Then subtract what disappears in retirement, the commute costs, the professional wardrobe, the work lunches, potentially a second car. Add what appears. Healthcare premiums if you're retiring before 65. And remember, those are potentially $12,000 to $20,000 a year for a single person before Medicare kicks in. That real number, multiplied by 32 for the conservative portfolio target, or divided by 3% for your dividend pipe target, is your actual goal. Start there. Everything else is an asset strategy to hit it. 2, if you're starting a dividend component today and don't have access to a specialist with a documented 15-year track record of managing dividend growth portfolios through full market cycles, start with ETFs. Vanguard Dividend Appreciation, Schwab, US Dividend Equity, ProShares, NOBL. Set automatic dividend reinvestment until you are 3 to 5 years from your target retirement date. Then switch to income mode and let the distributions land as cash. You are not trying to beat the market. You are building a pipe that pays you every quarter while the pipe grows. That is a completely different objective, and it requires a different mindset than chasing total return. 3, this week, not someday, this week, look up the long-term capital gains 0% income threshold for your filing status in 2026. Single, $49,450 of taxable income. Married, filing jointly, $98,900. Open a spreadsheet and map what your retirement income would look like, drawing from a 401k versus a Roth IRA versus a taxable brokerage in different proportions across a single calendar year. If you can shift your effective federal tax rate from 20% to near zero on $65,000 of annual retirement income, that's $13,000 per year you keep. Over a 25-year retirement, that's $325,000, not from earning more. From understanding one number in the tax code that has been sitting there the entire time you've been working. Every morning you show up to work as the only pipe in your own financial system, you are running a single point of failure operation on your entire financial life. One layoff conversation, one health event, one reorganization, and the water stops completely. These 3 pipes are not built overnight, but every year you spend building them is a year you are not waiting for permission from an employer to stop. Lazy investing built more fortune than crypto memes. And if you're the person who's been saying they're going to start taking this seriously for the past 2 years and hasn't, the best time to start was 2 years ago. The second best time compounds from today, not from when you feel ready. Disclaimer: this script is for informational and entertainment purposes only and does not constitute financial, tax, or investment advice. Consult a qualified financial professional before making investment